Welcome to the First Property Group PLC conference call. At this time, all participants are in a listen-only mode. Later, we will conduct a question and answer session. Please note that this conference is being recorded. I will now turn the call over to your host, Ben Habib, Chief Executive, First Property. Sir, you may begin.
Hi, good morning everyone. Thank you very much for attending our meeting for the interim results for the 6 months to 30th September 2012. I'm joined in the room by George Digby, our Finance Director, as well as Jeremy Barkas, our Marketing Director, and all three of us will be happy to answer questions at the end of this presentation stage of the call. I've got in front of me a presentation which I believe is on the web, and people can follow me going through it. I'm assuming for the purposes of this call that people know what First Property Group does for a living, but if there's any ambiguity about that, perhaps you could ask questions at the end.
You might say it's under the Investor Relations section of the website on financial reports.
The presentation.
Yeah.
So for those of you who haven't found it yet. But going straight to page 5, profit before tax for the 6 months to 30 September was down from 2.54 million to 2.21 million, a reduction roughly of about £300,000, which can almost entirely be explained by foreign exchange movements. Assets under management were also down by about 25 million, 20 million of which was down to adverse foreign exchange movements. Net assets of the group were up as we accrued more earnings. Our cash balances are very healthy, up by 31% from 9 million to 11.7 million. That's a function both of retained earnings as well as the sale of a property that we owned and which we announced in September. Diluted earnings per share were down in line with our pre-tax profits, roughly, slightly less reduction percentage terms than our pre-tax profits. In terms of the two major segments of the group, profit before tax from fund management was down by about 10%, and profit before tax from our group properties, which as shareholders and analysts might recall, comprises the one property we now own in Warsaw, together with our shareholdings in the various funds we manage. And the profits there were down by 14.6%. And you can see the foreign exchange rate movement in the last line of the slide on page 5, which shows that for the comparable period last year, we were working on a euro-sterling exchange rate of 1.135, and this year we've been subject to roughly 1.25, so quite a severe foreign exchange movement against us. Turning over to page 6, a chart we're proud of, which reflects the dividend history of the group, charted throughout the credit crunch, and as shareholders will note, our dividend has broadly increased through the credit crunch period, quite remarkable, even though I say so myself for a property company. We've held our interim dividend steady this half year, whereas in the past we've been ticking it up. And the reason we've held it steady is that we want to maintain a healthy dividend cover, and given that profits were down, albeit for largely foreign exchange rate reasons, but because profits were down, we've held our interim dividend at the same level as last year. Turning to a breakdown of profits within the group, there was a marked increase in contribution from group properties last year, largely as a result of a fund that we set up in October 2010 called Fprop Opportunities PLC, or Fprop. Fprop bought a couple of properties which are high returning investments, and because First Property Group owns 84% of FOP, we effectively got a significant benefit from the profits that FOP owns, so that the group now is fairly balanced between fund management income and income that we derive from FOP. How that changes in the future really depends on the extent to which we raise third-party money into FOP and other third-party funds. Paradoxically, if we raise more money into FOP, we'll probably see our earnings from FOP drop because our percentage ownership of it will reduce. That would be a temporary reduction until we have invested the money we raise. So if all goes to plan, paradoxically, as I mentioned, profits derived from FOP will initially drop before they start growing again, and it's worth perhaps bearing that in mind. Turning over to page 8, which largely covers what I've already mentioned as far as at least foreign exchange rate movements are concerned. The operational highlights I think that are important to mention is that funds under management have continued to perform well. We've stuck to our established policy and investment philosophy of buying high-income producing property, sustainable high-income producing property, and that is what has seen us so well through the credit crunch and continues to do so. The total pre-tax income return earned by funds under management in Poland was 21% on an annualized basis. Those are geared funds. A lot of the gearing was put in place pre-credit crunch. It still has quite a long time to run. I think we've got a weighted average unexpired debt term across our portfolio of over 4.5 years. And because interest rates are so low and our income in the funds has been sustained at such high levels, the income return has been really remarkably good. In the UK, our funds are returning 6.5% on an annualized basis, and the reason the UK funds are so much lower is really a function of the fact that the UK fund is not geared, so that's an ungeared rate of return. Looking forward, where we've got effectively two main growth areas. The first is to raise a new UK fund which mimics the fund that we've just virtually fully invested, called UK Pension Property Portfolio, or UK PPP. UK PPP, as shareholders and analysts will recall, is a very defensively orientated fund. It was set up in 2010 when the credit crunch was in full swing and had been in full swing for over a year. It has bought what we regard as recessionary resilient property, mostly discount retailers in the UK, and we wish to mimic that philosophy in our new UK fund. We think UK PPP is doing very well. We've got close to 0% vacancy in the portfolio, and we think a similar fund would continue to do well. Shareholders have probably read the FT headline this morning that austerity is going to continue to 2018. We see that as a vindication of our philosophy in investing in discount retailers, which should continue to do well in this austere environment. Then the other leg we've got is FOP, which I've touched on already, and that is principally focused on Poland. We see Poland, I'll come back to our, how we see the various markets, but we see Poland as a much better place to be than the UK from an economic perspective. So FOP is more expansive in its investment approach and takes on more asset management intensive property. As a result, is able to drive higher rates of return. Shareholders and analysts may have also read that First Property Group is looking to go into the debt markets. It's something I haven't mentioned in the statement, and there's not much that one can say at this stage of our endeavour, but we do think that the withdrawal of banks from lending against commercial property, as well as certain regulatory changes such as Solvency II, is going to mean that non-banking institutions are going to be drawn into lending on property. The rates of return for lending against commercial property now are better than I've ever known them in my working career, and we are looking at ways of entering that market, and we're working on a couple of interesting deals at the moment, but it's too early to make anything formal of it. So turning over to page 10, we have a breakdown of the various funds we manage. We've got 6 funds under management, the largest of which is USS. Of the £347 million of assets under management, £215 million relate to the USS fund that we manage. That fund ends in August 2015. We do not expect USS to renew that fund, and we will be realizing the properties in that fund over the next 2 or 3 years. The big question mark, therefore, that the group has to answer is where and how we're going to replace the income that comes off that fund. As I mentioned at our AGM this year, whilst I cannot say with any degree of certainty that we will replace the assets under management that we are likely to lose as a result of the realization of the USS fund, I am very confident that we will replace the earnings that we derive from that fund. And the reason I say that is we've got £11.5 million on our balance sheet, which we intend to deploy going forward. We will deploy that in high returning investments, either through Fprop, without Fprop having raised new money, or with Fprop partnering with other institutions. But in any event, we intend to invest that money. And once invested, we would expect that money to generate a very high rate of return. So we are pretty confident that we will replace the earnings that we will lose from the USS fund, but we are less confident that we will replace the AUM that fund gives us. And of course, life is all about earnings rather than AUM. So we're quite relaxed on that front. In terms of breakdown of AUM, we've talked about how it's broken down between our various funds. USS is a pension fund, so 89% of our assets under management come from pension funds. Again, that complexion is likely to change as we go forward and we raise funds from non-pension fund entities. We're in discussions with a number of entities that are more private equity type orientated, and I would expect a different sort of chart in the years ahead. Our investments in Poland represent 69% of assets under management, and we expect Poland to continue to be a significant proportion of AUM going forward. The exact split between UK and Poland really depends on how successful we are and the speed at which we raise funds for Poland versus the UK. And we could see Poland reduce or the UK reduce as a proportion of total AUM. That will not signify really our attitude to either jurisdiction. It will merely be a function of which jurisdiction we've been more successful in raising funds for. And again, as shareholders and analysts will know, we don't really intend to increase our exposure to Romania, which has been stagnant ever since we made our acquisitions there in 2007. Page 12 sets out the rate of return we've earned for our various funds. I'm happy to take questions on that at the end of the presentation. I don't see much benefit in going through it in detail now. Page 13 is a chart again that shareholders and analysts would have seen before. It sets out the stages at which we bought our various properties in the UK and when we sold them. And as you can see, we got out of the UK before the onset of the credit crunch, and we got back into the UK after the credit crunch had come through. The tail end of that chart indicates that property values in the UK have fallen quite a lot between September 2011 and September 2012. We haven't actually experienced that. These are figures taken from CBRE, but our portfolio and our reading of the market doesn't reflect it, and we suspect that CBRE's figures are based on more tertiary properties being taken into account. So we haven't, we see the market as having softened this year, but nowhere near as markedly as that dip in values would suggest. I'm going to skip page 14, which just gives you a breakdown of the various tenants we've got in our portfolio in Poland. Page 15 sets out a brief synopsis of the only asset the group directly owns, which is the Blue Tower in Warsaw. We bought that for $12.9 million in December 2008. It was most recently valued 30th September 2012 at $19.7 million. The income return on it is phenomenal. In the first half this year we earned £356,000 pre-tax profit on it, which represents a 41% rate of return on equity, and we expect that property to continue to do very well for us. Page 16 gives shareholders a breakdown of the various percentages we own in the various funds we manage, the book value of our investment, as well as the market value of those investments. And I can take questions on that at the end of the meeting. I think, with the exception of questions, I'll do Outlook before we go to questions. I have touched on Outlook already. I'm just moving to page 20 now. Clearly, our particular outlook as a company depends on what we can do in the UK in terms of raising new funds, as well as Poland and the investments we do. We had effectively ceased buying property in Poland when the Eurozone sovereign debt crisis really kicked off in the second half of 2011. We think that has stabilized pretty much now with the two LTROs undertaken by the ECB, as well as, and perhaps most importantly, its more recent open monetary transactions, which, a bit like the Fed, equate to unlimited quantitative easing as far as we can see it. And this quantitative easing has been very good for Poland. Every time we've printed money in the West, money has flowed into Poland. And even though the Polish economy is now slowing, and I'm moving really on to the prospects for Poland, even though the Polish economy is slowing, we don't think it'll enter recession. We think it'll continue to grow. It hasn't entered recession since the onset of the credit crunch. The quantitative easing in the West is good for our assets in Poland, and even though the monetary cycle in Poland is now going to be turning to a sort of looser approach by their by their central bank. Interest rates are forecast to be cut. We don't think the zloty is going to weaken markedly either because of what's going on in the West. The zloty-euro exchange rate is important to us. As shareholders know, most of our tenants in Poland pay their rent in euros, so if the zloty weakens markedly, they come under pressure. But we don't see interest rate cuts in Poland translating into a materially weaker zloty, and certainly that hasn't been the case so far. And interest rate cuts have been well flagged. So we think Poland will slow, but we think in the medium to long term it's a tremendous economy to be part of, and we will, given the greater stability now in the West, be more expansive in our investment approach in Poland. The UK, we think, will go on suffering. We've said that now since 2009. I think since 2009 we've been saying that it's going to be a very protracted and slow recovery in the UK. And the headlines in the FT today are to be believed. It's going to go on until at least 2018. I read in one of we have a perception audit done of First Property Group before analyst meetings like this, and one of the perceptions I read was that we had been wrong as a group in forecasting or concluding that the London market was in a bubble. We haven't been wrong in that assessment. I don't know which analyst it was that had that view, but we haven't been wrong in that assessment. London is undoubtedly in a bubble. What I've always said is that we can't predict when that bubble is going to burst. No one can do that, otherwise we'd all make billions. But it is undoubtedly in a bubble. And anecdotal evidence I have from friends who deal in development property in London is that the market is slowing quite fast at the moment. So perhaps we're nearing the top of that bubble. And I haven't really got anything else to say. I think I've covered the results in a fair amount of detail. So perhaps if we could have questions off the telephone first, and then we can have questions in the room. Ruth, are you still there? Are you able to field questions off the phone?
Thank you. We will now begin the question and answer session. If you have a question, please press star, then 1 on your touch-tone phone. If you wish to be removed from the queue, please press the hash key or the pound sign. If you are using a speakerphone, you may need to pick up the handset first before pressing the numbers. There is one person online with a question. Would you like me to get him to ask it?
Yes, please.
Okay. Chris Thomas from Arden Partners is online with a question.
Yeah, hi guys.
Hi, Chris.
Well, I couldn't be with you today, but as you hear, I'm still a bit croaky. Just obviously in your statement, you talk about working on a number of purchases for Fprop. I guess I'd be interested to know what you're seeing by way of pipeline and what the constraining factors are. Is it the sort of numbers of deals that you're prepared to contemplate, or is it the capital you require to complete those? And also maybe a little bit of comment on the sort of the banking situation for those deals you're trying to put together.
Yeah, if I can deal with your last question first, Chris. I'm talking about Poland really, if we're talking about Fprop. The banks in Poland have been profitable throughout the credit crunch. They continue to be profitable, but for the first time since the credit crunch kicked off, I have seen a marked tightening in bank lending conditions in Poland. This is largely driven by their Western parents suffering liquidity issues. The liquidity problems were most marked in the latter half of 2011, but with margins, etc., having been restricted and tightened then, we don't expect those margins to reduce, to come back to sort of more palatable levels perhaps, until competition between banks for lending on commercial property arises again, and that's going to be a long time away. So we think that notwithstanding the fact that the banks in Poland are healthy, and we expect them to continue to be healthy, the landscape for lending against commercial investment property has tightened, and that was one of the reasons we stopped buying property, because we wanted to see where the banking lending market was going and what effect that was likely to have on values. We have seen values come off in Poland, both for prime as well as more markedly for secondary property. So we do see higher yields available for those. I think, a wholesale approach to investment in early 2011 would have proven to have been a time when investors would have overpaid for property. I think the same properties now could be bought more cheaply. But the flip side of the tightening in the markets is that we do see some really interesting opportunities now. So we're working on one deal at the moment, which I know, Chris, you're slightly familiar with, where the rate of return on equity, it's a sale and lease back, the rate of return on equity we earn will be over 30% per annum. That's a function of highly structuring the deal, both on the bank debt as well as with the vendor. Sale and lease backs are perhaps one of the few areas where the landlord or buyer has the whip hand in terms of his negotiations with the tenant. And so you can do fairly sweet deals. That's one deal that we're working on at the moment. We're also working with a bank on assisting it with resolving a slightly problematic situation where a previous borrower had borrowed in Swiss francs against their commercial property. The property itself is performing perfectly well, but is now underwater because of the strength of the Swiss franc. We see those kinds of opportunities coming forward more in Poland. So the banking market has tightened. That, of course, has an effect on one's ability to raise capital, but it does open up other opportunities. And what is important to note is that you don't want to be in the market buying property as that tightening is taking place. And we pulled out in the middle of 2011 because we could see that there was a sea change in the capital markets taking place. But now that we've got this OMT and we've got unlimited supply of money in the States, I think we can enter the landscape broadly knowing, how it is. Does that answer your question, Chris?
Yeah, I mean, just the sort of the follow-up is really in terms of the constraints for you doing deals. Is it the number of opportunities you see, or is it the capital at your disposal currently?
I'd say it's more the former than the latter. You can't really test the latter till you've got the former. We need to have good deals in order to raise capital. But based on our conversations with prospective investors, as long as we can find good deals, we'll get the capital for them. We've always been held back in good and bad times by, lack of deals that we wish to do. We look at millions of deals all the time, but there are very few that we actually take across the line because we can't either get the rate of return we want, or there are due diligence issues which we can't adjust for in pricing terms. So it's always going to be the former, I think, that holds a company back.
Okay, thanks.
Any other questions online on the telephone?
We have no further questions from the phone right now. I will now turn the call back to your host.
Any questions in the room?
Maybe just taking that one forward a little bit and going back to a point you made earlier, which was about the dilution in Fprop, and that would imply that there were more funds arising. But you were saying there now that the constraint was on doing the deals. Maybe you could just explain that a little bit further, why there'd be a surplus of cash awaiting deals.
Well, I mean, at the moment, we are in a phase of actually working on quite a few exciting deals, which is a phase we haven't been in for about over a year, as I mentioned. So we've got the prospect of good deals out there, and it's the confidence that we have that there are a number of deals out there that we're working on, some of which should come through, that allows us to go ahead and raise money. We wouldn't want to raise money and just dilute our position for no good reason, unless we could have some vision of where these deals are going to come from. So we've got some view of that now, and so we do feel it makes sense to go out and raise the money. It is slightly chicken and egg. You can't do the deals without the money, but you won't get the money without the deals, if you're with me. So it is slightly chicken and egg, but we're moving both forward in tandem at the moment. There may be a seesawing effect on profitability in FOP. So we see a slight reduction in profitability in FOP as we raise new money, and then we invest it and we see its profits go back up, and then, there's no easy answer to that slight seesaw. But the reduction in profit in FOP, if it should happen because we've raised new money, is ultimately a positive for shareholders in First Property Group, because it means we've got better prospects and we'll be doing better deals, more deals.
Okay, so you don't really have full clarity on the sequencing yet,
no.
The money raising versus...
No, I mean the nature of buying property, commercial property at least, is you're hunting elephants. We're not buying lots of little flats all over the country which have incremental difference, make an incremental difference to our assets under management or our profitability. We are buying assets that are worth 20 million or 30 million. We're working on an acquisition of a 50 million portfolio. These things are step changes. They're not incremental. Any other questions in the room?
Just wondering, exposure to Carrefour in Poland. You do have quite a large percentage of your tenants there. I don't think it's one of the troubled areas, but how do you see that going forward?
Well, the hypermarket / supermarket sector is a sector we love. We think if you've got a dominant supermarket or hypermarket, it's perhaps this is putting it too strongly, but it's effectively a license to print money for the operator. And if the operator can protect that dominance and do well out of it, we as landlords over time should do well. So we're much more motivated by the location of that particular hypermarket we own than the fact it's let to Carrefour or Tesco or whoever. I do accept we've got one significant Carrefour hypermarket in the USS fund, and FOP owns a Carrefour hypermarket as well. Both these properties are let on long term, so till 2021, end of 2021 in the case of the one owned by FOP, of what we regard as a sustainable rent. The one that's owned by FOP also has development potential, and we've applied for planning consent to add another 3,000 square metres of retail warehousing in the car park of the Carrefour hypermarket. If we gain that consent, about which we are confident, we've been told by the local planning officer that she supports our application. We're waiting for Highways to come back and give it the nod on the ratio of car parking, which has been a bit of a debate between us and the Highways authority. But if we get planning consent for that, the rate of return for that particular hypermarket will be transformational. I think we'll double the rate of return that we were expecting coming out of that investment, which anyway is producing 30% plus based on the rental flow that we're getting. But just coming back to Carrefour as a covenant, the first thing to say is that we do believe the Carrefours trade well, so that's the most important thing. The second thing is we do have not just Carrefour Polska as our tenant, but we have Carrefour SA in France as the guarantor of those leases. Notwithstanding the troubles that Carrefour has had, it is still a very strong covenant. I think it is the second largest retailer in the world. just slightly ahead of Tesco and behind Walmart, which puts it in, a very strong position. So we don't have any particular issues over the covenant. The risk, I suppose, from a covenant perspective, is that they sell their operation in Poland to another operator that isn't as good a covenant as they are. I meet with the finance director of Carrefour Polska quite frequently. He's become a bit of a mate. And he tells me, I suppose he would, but he tells me that they are committed to Poland.
I think they are actually now.
And,
off the top of my head, yeah.
and any press comment that may indicate otherwise is misplaced. And I know Real are exiting Poland. They're selling their operation to Auchan. But all of these hypermarket operators are pretty good covenants. An ideal for us would be a sale to Tesco, frankly. It's a covenant that we understand in the UK better than perhaps we understand Carrefour. So, we're pretty relaxed is the answer. The short answer is we're relaxed, and I've given you the long-winded one as well. Any other?
You were saying that you're in the process of raising a new UK fund, and you also were saying that over the last couple of years some of the discount retailers have been quite profitable for you in the UK. I mean, how do you see the UK property market at the moment, and where is your focus in terms of doing deals now?
Yeah, well, obviously Central London is not a place we're focusing on. I'll just digress for a moment. Even though we would not buy property in Central London, if we are successful in developing a debt product, we'd be happy to lend against property in London. They're quite different propositions. So Central London is off the cards, and that effectively means we're not buyers, because I think it's fair to say that the entire world pretty much now is narrowed its definition of prime to the extent that perhaps London is the only thing that can be defined as prime. So we're not buying prime, and we've always seen good secondary property as a better investment proposition than prime. It comes back, Brian, effectively to our philosophy, which is that over time the only thing that really matters in long-term commercial property investment is income levels. How much income are you getting out of your property? You can't get much income out of Central London property. So we're looking at good secondary in the provinces, and good secondary for us means a well-located property for the use to which it's being put, low rents, and by that ideally we mean properties which have already been subjected to a default by a tenant during the credit crunch. A new tenant has come in and it's on pretty low rents as a result of that. And ideally discount retailers, because they drive a very hard bargain with landlords, and they are going to be the flavour of the month going forward in terms of where people shop. You would have seen that Terry Leahy has just agreed to join the board of B&M, which is being taken over by a private equity firm of which Terry Leahy is part. But that's symptomatic. The fact that B&M can attract someone like Terry Leahy to come in and run their business is symptomatic of how that part of the market is doing so well, and we think that will continue to run. So we don't really mind if a property is in the north of England. There are people who live in the north of England and they spend money in the north of England. The key is having the right property for that location. So we're looking at a property, for example, in Wolverhampton at the moment, which follows a similar sort of format, and we're buying off an attractive yield. And a lot of investors might go, ooh, Wolverhampton, not sure where Wolverhampton's going, but you just got to believe that people will continue to live in Wolverhampton and shop, and we believe that they will. So we're just buying the right property for the right location, for a given location.
Can you say the same about Poland? Which areas are you focusing on in Poland?
Yeah, the areas that we like most are, again, retail warehousing. We prefer retail warehousing over shopping centres. Shopping centres are great when the economy is growing at a rate because you can go on edging your rents up quicker. But shopping centres are living beasts and they're almost operational businesses. Retail warehousing, you tend to have longer leases, lower rents, and you get more clarity of where your income is coming from. And even though we expect Poland to continue to grow, we think that the retail warehousing sector in Poland is likely to provide better long-term returns than shopping centres because of the lower rents and the clarity of income. So we like retail warehousing. And again, right across Poland, we don't really mind where it is as long as it's got a good location and a catchment big enough to sustain its business. We love Warsaw for retail, and one of the sort of distressed situations we're working on is a Warsaw retail asset, which is exciting. We also like offices, but we are much more selective on where we would go for offices. We like the central business district of Warsaw a lot. We think that will always hold up. We are very nervous of southern Warsaw and western Warsaw, where there's been a lot of development. Don't know if you've ever been to Warsaw. Mokotów, yeah. We don't. We're nervous of Mokotów. I see Heitman just bought Marynarska, which is a large investment developed in their 8 by Gilanko in Mokotów, and I'm sure Heitman have a very sound investment case to be made for that building, but we would be nervous of buying it. And the reason is quite straightforward. Warsaw's flat. If you fly into Warsaw, you'll see that it's very flat. In fact, Poland is very flat. So you can go on building, out, and it makes your assets less defensive. The CBD is a tight area, and we prefer to be in that tight area. Most Polish cities don't have defined CBDs. Warsaw is one exception. So if you were to go to Katowice, it's just a sprawl. There is no CBD. So we wouldn't buy an office block in Katowice. We would look at the main cities, the main CBDs of main cities, to buy office blocks. The other thing you've got to keep an eye on, obviously, is your exit from a property investment. And there's no real investment market for offices outside the main cities. So we'd be nervous of buying offices outside the main cities for those reasons. Logistics is something that we would do, but only where we get long leases to good covenants on high yields. Logistics is not something we don't really specialise in it, and there are better players out there to do logistics than First Property Group. We will do light industrial logistics and so on, but only if we get a long lease to a good covenant and it's clear how we're going to be making our money out of it at day one.
Would you go with a partner, perhaps?
Yeah, but again, it's a bit like shopping centres. You either go for the active management approach and you've got lots of units on a park which require to be relet on a repeat and frequent sort of basis. And again, because Poland's flat, you can build these sheds anywhere. And I think that what we're looking for is properties which are defensible somehow. They've got to have some defensive characteristics. And if you can build a new warehouse next to an existing warehouse, the defensive characteristics are limited. So we really want long leases. The other thing that's quite peculiar about industrial property in Poland is that the cost of building industrial property is almost always higher than the cost at which you can buy existing industrial property. And what that means is that you're likely to suffer depreciation if you buy a new property. So again, you need a long lease to get comfortable with trading your way out of a new proposition. Any other questions in the room? Any other questions on the telephone?
Once again, if you have a question, please press star, then 1 on your touch-tone phone.
Great. Well, if there are no further questions, Ruth, I think we can bring the meeting to a close. Well, thank you very much, everyone, for attending on the phone and coming in person. Thank you.
Thank you, ladies and gentlemen. This concludes today's conference. Thank you for participating. You may now disconnect.